Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, we have a weak ISM report this morning that seems to put a halt to yesterday's rally. So after Friday's sell-off, where does that mean we go from here? Interested to hear Rob's thoughts on that, along with the tariff rumors and everything else that's lingering out in the distance there. So let's get right into it. Robbie out there?
I am Zach. Hey everyone. Happy Tuesday afternoon. Welcome to TradeFinder Live. Lots to talk about as far as news events. You mentioned a bunch of them there, Zach. We did have a weak ISM report this morning. The services sector is the one that's concerning. About 70% of the economy in general. So that kind of moved the market down a little bit. But when we look at the chart, it is a good question. Where do we go from here? You can take a look at the sell-off that we had on Friday, where we had a gap down following the reversal on Thursday. And then yesterday we rallied back, right back to the 10-day moving average, trading a little bit above it right now, but hovering in this area just at the bottom of this pennant pattern. So is this a breakout and a test of the pennant? I think that's still possible. Would not be surprised to see the market come down and test that 610 level and the 50-day moving average. A lot of chatter about the Jackson Hole big event at the end of the month, big financial event. The Federal Reserve representatives will be there. Will they give us some sort of an indication on whether or not they may cut in September now after that weak jobs report on Friday, which is cited as the catalyst for pushing the market lower? It wasn't so much the headline numbers I mentioned in the U.S. market update over the weekend. It was the revisions. And if you go back through the entire year, revisions have been down over 400,000 jobs. It wasn't just the 258,000 for May and June that caught everybody's attention. It's that the BLS, Bureau of Labor Statistics, seems to be or have been quite a bit off on the employment numbers. So obviously that cost somebody their job. But anyway, back to the markets. Weaker ISM report. Perhaps the market is looking a little bit towards this potential rate cut scenario in Jackson Hole. September almost seems optimistic, as hawkish as the Fed was last week, and they were very hawkish. As far as the technicals of the market, so far all we've done is fill that gap that we dropped down on Friday. So we got most of it back yesterday, rest of it back today, trading just a little bit lower right now, but not a whole lot. And it will be interesting to see where we close today. I mentioned yesterday to our folks at Evo Trader Live that we needed to see what the last hour brought. And we did continue the rally in the last hour. So what happens today? Do we reverse back down or do we continue higher? And this was just a little momentary blip, and the market is going to continue to power to the upside. So even if we do come down here and test this level, which I think would be healthy following this run off the April lows, there hasn't been much of a correction. It's only about a 5% correction or so. So we're not talking about anything significant as far as a move down, but we haven't tested the 50-day moving average since May. So another test would not be surprising at all. The market tends to do that in a trending environment, test the 50-day moving average periodically. That's quite normal technical analysis. And I feel like that's probably a pretty good chance of occurring. But I could be wrong. Maybe we just turn and run back to the upside from here. Let's see if we can get some cues from the bond market. So I'll go right to TLT. Again, for those of you that may be new joining us, if you are new, welcome. Get new people every week. The TLT is the 20-year, and it reveals prices. Prices and yields move inversely. So when you see prices going up, that means yields and rates are going down. So the fact that we are moving up in price means that rates have been coming down, which is a little counterintuitive. If the Fed was so hawkish, didn't give any indication of a rate cut anytime soon, specifically in September, you would have thought that rates would have started to go up, not down. So, what would cause this to happen? There were two zigzags on here that I took off just so that we could have a little cleaner chart and get a little better idea of where things may go. You can see we did have this triangle here. It wasn't the most well-formed triangle because there is a lot of empty space here. I like more symmetry in the triangle formations. In other words, more touches of the trend lines on both the lower highs and the higher low side. So we had this small triangle. We broke out, came back, tested the point of the breakout, commonly done, and then we moved to the upside. Are we going to do that again in the bond market? Are we going to start having rates come back down? I don't think that would be too surprising. And then we also had this other downward zigzag right here that hit the 100% extension dead on. I took that off again so that we could see the chart a little bit better. But that was the starting point where I have this trend line here of the zigzag. We already retraced the entire C wave. That's the first thing that happens when a zigzag is completed is you retrace the entire C wave. And if you continue in that direction, oftentimes you retrace the entire zigzag. So if we're going to do that, that means we're coming up here on the TLT, which means rates may go a little bit lower before perhaps coming back down to test the point of the triangle. So right now, the market, everyone's looking towards the next event we could get as far as some information from the Federal Reserve. You probably know already that there were two dissenters on no rate cut, first time since 1993 that's happened. So been quite some time since there was more than one dissenter in the Fed that were in favor of a July cut. So that was a bit unusual. So we'll see where things go. I think I can go ahead and take this trend line, trend channel off here as well. And now we're just looking at the breakout of the triangle. Do we hit resistance here? And then do rates start to come back down? If we look at TNX, you're going to see the exact opposite. You're going to see rates going down out of its own triangle pattern formation. Now TNX is the 10-year and it does show interest rates. So TLT shows prices, TNX shows rates. So again, rates and prices move inversely. So the rates going down, it tells you prices have been going up on the TNX. And we wonder if we go back and test the point of this triangle. Note when we had this not well-formed triangle back here either. Again, too much open area here for my liking, but nonetheless a consolidation pattern, and we broke out of it and came back and tested the point of the triangle. So in the case of the TNX, that would be a move back up in rates, back to test the point of that triangle. And I do think that that is likely to happen. If that happens, what does that mean for gold? So let's just jump to the metals and then we'll come back and look at the rest of the markets because that could be very interesting to see what occurs if we look at both the metals and the dollar. There's that triangle formation and it just can't make up its mind, gold, what it wants to do. We had this attempted breakout to the downside, but the rules, as you've heard me say so often, you break out of a triangle, you break a major point of resistance, major moving averages, whatever, you have to have a follow through or confirmation day. And there was no follow through or confirmation day. We moved back up. And so then right back up into the point of the triangle. And then it looked like perhaps a false breakout to the upside because no follow through, at least as of yet. That could still change by the end of the trading day. But for now, not a follow through on an upward breakout either. So we're just kind of playing around the point of the triangle with the 10, 30, and 50-day moving averages all converging right into the point of the triangle. The only thing we know for sure is that something is going to happen. Make this a little bit tighter in the near future in gold. We still don't know which direction it's going to be, but there's a breakout coming in GLD. And so we're going to watch that rather closely. Switching over to silver real quick. We don't have a triangle formation in silver, but do we have a little bit of an indication of which way the metals may want to go? I drew these lines here because I like symmetry and not just the triangle formations, but in the LA wave patterns, zigzag patterns, etc. I like it when they're visually symmetrical in the patterns. And when you look at this 5-wave pattern here on silver, it's extremely symmetrical. And this wave 5 movement to the upside may well be underway. We need to break above that 10-day moving average. Then the next stop would be breaking the wave 3 high. And if those occur, likely we're going to this wave 5 target here, this tap box time and price projection. And as most of you have heard me say numerous times, but if you haven't gone to hub.com, HUBB.com, and gotten a copy of the software, you can go get it for free. You get the LA Wave for free. You do get an opportunity to subscribe to AI signals if you want those, but the software itself is free. And talking about the AI really nailed silver. It had given us a target price right here way back in June, and we broke up rather quickly to that level, stayed there for a month, broke it out again, formed the wave 3, got a little too far from the 10-day moving average, got a little vertical. What goes vertically up oftentimes comes vertically back down, which is what happened in silver. So just boom, boom, right straight up, right straight back down, and held a very logical spot on silver. Not only this AI signal here, but the 50-day moving average and a 38.2% fib level. Very logical point for silver to bounce, and it has. Can it continue? Well, there'll be follow through to the upside, and silver likely would coincide with an upward breakout from that triangle in GLD, but completely different patterns. You see this from time to time with the metals. Gold and silver are normally moving somewhat in the same direction, but they again oftentimes have different patterns as they do now. Completely different patterns with this 5-wave impulse in SLV and a consolidating triangle. That you don't pay any attention to the LA wave pattern when you have a triangle. That was one of Elliott's rules. The triangles trump everything. Pay attention that know that it can break either direction. So this 5-wave pattern could fail, or we could come down and have a lower wave 4. We could come all the way down to 61.8, as you probably know with LA wave rules on the wave 4, and still have a solid move to the upside in a 5-wave pattern, or we could just continue here from that 38.2% level. So really interesting, I think, that the two patterns are so different in their construction. And I mentioned the dollar. Let's go take a look at the dollar, see what it's showing us. It's been giving us really good, solid foundation down in this area. I was a little surprised that we got this bounce higher in the dollar at the end of last week, especially with the market moving down. You would have thought that that would have moved down as well, especially with the rates going down. Seemed like that would have brought the dollar down, and it's starting to catch up now with a little bit of a movement back down. We're staying real nicely in this pretty small corridor of a trend here, sideways trend between 97.5 and 100 on the DX spot. So just a little bit to the upside here, overreaction a little bit to the downside here, and then right back into it. And when things overreact one way, they often overreact the other way and then balance out. That happens a lot in the markets, and the dollar is a pretty good indication of that. I've mentioned before, I really don't want to see the dollar come all the way down here. I feel like that would start to create a little bit of concern on whether or not foreign countries were dumping the dollar, that the dollar may lose its spot as the bastion of last support, currency of last resort, all those type of cliche comments that you hear talked about. We did get the Genius Act passed in the crypto space, the stablecoin legislation, et cetera, which is designed to help support the dollar, and perhaps that keeps it from breaking all the way down here. But I think this would be quite worrisome if the dollar were to move down there. But staying in this range on the lower end is very constructive for earnings of companies that have international exposure, not having to worry about the currency exchange rate. It actually helps them in their earnings with the dollar being a bit lower. So I think everybody's pretty content, myself included, with the dollar staying down in this range. We don't want it to take off too much to the upside, which is a possibility if we do get a move back up in rates. If both those triangles get tested on the TNX and TLT, rates start going back up, that could put a bid back under the dollar, and then that could be worrisome for companies with their next quarterly earnings reports. We're right in the middle of this quarter's, as I'm sure you've seen some of the big earnings reports. Palantir last night just set a benchmark for blowing away an earnings report. Well, it was pretty amazing what occurred there. So let's go ahead and take a look at the VIX. As I mentioned, we're right back down on the VIX. And so where we had gone up on that sell-off on Friday to 22.5, we're coming back down. We're testing this triangle. Remember, just because it's a descending triangle does not mean it's going to be a downside breakout. Any triangle can break either direction. We broke out, didn't get any follow through there either. So just back down, testing this. That could still be a false breakout, or maybe we just get rid of the lower trend or the upper trend line of lower highs, and then just stay in this range that we've been in for quite some time, between 15 and 22.5. Perhaps that's where we end up moving forward. It's going to tell us, the market will tell us where things go from here. But a break above 22.5 on the VIX, and then you start to get concerned about more downside in the equities markets. As long as we stay below 22.5, seems to be okay, just short-term periodic volatility. But I do want to note that even staying above 15 is still slightly elevated volatility. So still a little bit of extra volatility priced into the markets at this point in time. And we'll watch that 22.5 level. If the markets do turn and rally, a lot of people are concerned about the month of August, and then it's followed by September. Neither one of those months have been viewed as being very positive for the markets, at least historically. They haven't been. September normally even worse than August. But the Fed could change that if they do give us any sort of indication of, well, the labor market is a little weaker than we thought, and perhaps maybe a rate cut could be coming in the September meeting. So that would certainly be something that could generate a rally in the markets and possibly break below this 15 level on the VIX. If we take a look at the cryptos, we had the big run, I think, in advance of what was occurring with the legislation, the Genius Act, et cetera. We didn't really get much of a follow through, just a consolidation once the legislation was actually passed, and a little bit of a breakdown. It's not a very large triangle here, but we're testing the wave 3 top, at least on BITB, which is one of the Bitcoin ETFs. There's IBIT that a lot of you favor, a lot of you make comments about on the US market updates on YouTube each week. It does have weekly options, but the options on both of these are quite liquid and both good leverage plays against Bitcoin, or with Bitcoin, whatever your viewpoint may be. But a little bit of a downside breakout here. And if you're long, you want to see that wave 3 high hold. You want to see this hold right here and get back above the 10-day moving average, come back up and test the point of this triangle, which should occur at some point. The question mark, though, right now for the short term, we did fill this gap when we moved vertically ahead of the legislation, has been filled. And the test of the wave 3, You want that to hold. You want it to hold right here and see if things turn around. Looking at Ethereum, which has had a pretty nice run and a pretty solid consolidation here following this run that was pretty vertical. This is about the best kind of consolidation you could ask for. Sideways to down, backing and filling. There actually been some people talking about that. You've heard me say that a lot, that phrase, backing and filling. Basically, that's sideways with a little bit of downward moves following big upward moves. That's what backing and filling means is you get a little bit of a back off. You go sideways a bit. Maybe fill a couple gaps from the way up, etc. When you have that kind of a consolidation, a lot of people calling for that in the equities market and feel like the SPY, the S&P might need to do that as well as the other markets. So with Ethereum, can we hold this level here at 25, which so far we have, and then mount a run back up to that upward trend line, at least on the ETHW, and again, optionable. With good liquidity in the options as a leverage way to play Ethereum if you're interested in trading them that way. We'll look and see if we can get that test of that high, but we got to hold this level here at 25 first. So first things first, hold here and then see if we can get a move back to the upside. We move to the energy space. Lots of chatter on the financial networks this morning, at least earlier this morning, talking about the power that's going to be needed. They're back talking about the data centers again, et cetera, and natural gas being a big part of that. But we have a lot of supply, and markets are supply demand driven by fear and greed. That's a summary of how the markets work. Pricing in the markets, you can get real technical on buys and sells and how many people are buying and selling, and that moves prices. But in general, those motivations are buoyed by supply and demand driven by fear and greed. And we have a lot of supply. So supply is outpacing that expected demand. We did get a run up here when everyone started realizing, oh yeah, we're going to be using a lot of natural gas for all these data centers that are going to be being built. Again, pretty good symmetry in the 5-wave pattern down. I mentioned I thought we would see 12 and a half on natural gas, and pretty much we did. Didn't quite touch that line, but we got awfully close, and maybe we still do come down and hit that line because we're still below the 10-day moving average. To get excited about natural gas, you got to get back above the 10-day moving average. There's a lot of headwinds here on natural gas. We got to get back above the 10-day moving average. We got to break the resistance line here at 15, and then right after that, we got to get back above the 50-day moving average. So before you can get too excited about going long natural gas, you could be very aggressive on any sort of potential bounce off 12 and a half, maybe back up to 15. But to see a sustained move, you want to see it back above that 50-day moving average. Then maybe we have something going. And I've been opining that, we had in some areas of the country a quite warm summer. Does that mean that some areas are going to have a colder than normal winter? If that's the case, then you could see maybe that would generate a bit under natural gas. But we know that's coming. The market always looks 6 to 9 months ahead. So we know the winter months are coming, and that has not been enough to create enough demand to outpace supply. So where is the catalyst to drive natural gas higher? Makes you wonder if there is one, if that can't be. I don't know, maybe when the first big snowstorm hits, maybe that could put a bit under natural gas. But for now, natural gas is just crawling to the downside without much of an upside catalyst in sight other than potentially the support at 12 and a half. You can see we're in this tap box here, time and price projection on natural gas. We're nearing the midpoint of it, which coincides with that support line at 12 and a half. Let's see if it can mount some sort of a bounce there. In the oil market, I've been talking about how I think OPEC is trying to manage this. 75 is their key level. You know, I've been talking about this trading range for the entire year. I felt at the beginning of the year that oil would stay in this range. 75 seems to be the sweet spot that OPEC likes, OPEC plus now, as they're called. And as soon as we started to get a bid under oil and look like maybe we're going to run up to 85, OPEC announced again that they're going to increase production. So why wouldn't OPEC want oil prices higher? Because now there's a fly in the ointment, which is if oil prices get too high, drives people, more people towards electric vehicles. They don't want to crush the supply demand curve on oil. They want to manage that as long as they can, and they want to keep prices elevated so they can make extra money, but they don't want them so high that it drives people away from gasoline powered vehicles. And perhaps we break this level. We're testing the 50-day moving average right now today. If we break below that, below the 75 level, perhaps we come back down here towards 70, or maybe we hold here at 75. We do have the 50-day moving average, as I said, and we are in potentially a wave 5 higher. So perhaps that was just a temporary move lower on that OPEC announcement, and we can hold here and get another bid in oil. But I'm suspect on this wave 5 occurring with the way OPEC is acting. It's the second time they have announced an increase in production. So they are very wary of letting the price of oil get too high. So looking at the rest of the equity markets, we take a look at the Dow real quick. You're going to see very similar charts here where we had the gap down on Friday. We recovered the gaps yesterday and today, testing the 10-day moving average here on the Dow, at least by the DIA. If we don't hold here and start to fall back down, we could come all the way down to 420, would be a move to the downside on the Dow. But let's see if we get back above the 10-day moving average. If we do, then we're going to be looking at testing 450 again, which could happen. The wave 5 is labeled here. We didn't quite make it in, got right to the lower end of the tap box. We didn't quite get inside there. And perhaps if we can break above 450, that 5 moves over and we get an extended wave 5 into the tap box. But if we don't hold the 10-day moving average, we could go lower. So we're kind of in a no man's land here on the charts of where the next moves are, to the upside or the downside. And I guess it depends on whether or not traders are going to be looking towards a rate cut on the back of a very poor jobs report on Friday, lower ISM services today, putting some concerns in the economy weakening, and how long will the Fed wait? I even heard that word stagflation again this morning with the concern over the ISM report and the fact that inflation is slightly elevated from where the Fed would like it. Historically, they've wanted it at 3% or less, and growth on the GDP around 3% or a little higher. And that keeps good, balanced, stable markets. The economy is growing enough to offset inflation. Well, now they want it down to 2%, and we're more in the 2.5% range. So if they're going to continue with that 2%, I don't see how we get a rate cut in September either. But all eyes will be on that Jackson Hole summit at the end of this month. And if we move to the Qs, which certainly have held in there well with all the earnings, had good earnings from Microsoft, Meta, Palantir last night, and we're back above the 10-day moving average here. Once again, also gap down on Friday, but doing a little bit better on the Qs than the other markets. We run back up here above the 10-day moving average, but where we close again is going to be key today. So we want to see the close. Back-to-back days where the last hour of trading matters a lot. If you wonder why you talk about the last hour, that's where the institutions trade. That's where the large volume comes in, and you can see how the institutions are positioning themselves. But without a doubt, the Qs have been performing better. The tech and AI is still leading the way in the markets. The Mag 7 stocks obviously are the ones that are driving things. If we take a look at the IWM, at least we've gotten back to 220. I thought we would go to 230 before when we broke 220 here. And we came up, came back down, tested 220, made a slightly higher high here in July, and then came back down, tested the 50-day moving average. The breakdown on Friday, recovered that right at the 10-day moving average, back above 220. Can we mount a run to 230? I think we need a pretty good rally out of the rest of the market. As you already probably know, the small caps, the ISM, the Russell, high WM, ISM on my mind, are indications of a risk environment because they are viewed as being higher beta names, higher risk type of names. So we'll watch and see if we close above the 10-day moving average here on the IWM as well. So sound like a broken record, but where things close today matters a lot over where we're going to go over the next week or two, in my opinion. Let's go ahead and take a look real quickly at a couple places around the world. And then we'll open it up for Q&A, showing the market in Australia. As we take a look here, see a little bit of a bounce back to the upside here off 26. Can we get to 27 this time? I thought when we broke 26 before, we would make it. We tried there in June, came back down, tried again in July. Once again, slightly higher high as the algorithm labeled the wave 5 here. And as I've mentioned in the past, the algorithm within the Hub software is created exactly, it's coded exactly to the algorithm as Ralph Nelson Elliott wrote it. So these aren't my labelings, they are the algorithms. And if you make a higher high than the wave 3, it labels the 5. Or the 3 moves over, but we already had the 4 labeled. So the algorithm thought that was a 4 and it labeled this as a 5. Now we came back down, tested the 50-day moving average, tested 26 again, and now we're moving back to the upside. Can we hit 27 this time on the EWA? Looking at Canada with all the tariff talk that Zach mentioned in the beginning, talking about some higher tariffs. Again, President Trump is, I think pretty much everybody realizes that the higher tariff threats are more negotiating tactics. Seems to be working with people wanting to come. Switzerland, for example, they were concerned about the fact that they sell so many Swiss watches here in the U.S. I forget how many billions of dollars the U.S. spends on buying Swiss watches. So they didn't like that tariff threat there. And apparently there's a contingent on their way to Washington right now to have negotiation talks. And so it seems to work. When President Trump threatens the higher tariffs, it gets people to the negotiating table. And then you've seen that somewhere around 15% seems to be the average of where the agreement is when the tariff agreements are finally announced. He likes to get investment. He was boasting today. A lot of people wondering where that money is coming from or going. But the deal that was concluded with Japan supposedly includes, I think, $500 billion investment in the U.S. You got that from the Middle East as well. And so cash and a little bit lower tariff seems to be where the negotiations end. But with Canada, just really not paying much attention to any of the tariff stuff, even with all the rhetoric going back and forth, and administration threatening higher tariffs on Canada again because they're not happy with where the deal has been. But notice how the EWC just kind of blows it off and continues running higher. We had this really nice run up the 10-day moving average, quick test of the 50-day moving average. Once again, I wonder if that's what our markets are going to do. Trending markets, as I mentioned in the beginning, tend to do that periodically, and we're back above the 10-day moving average there. A little bit different story over in Germany, where the markets seem to be a little bit more in tune with the economic data from Germany because the ECB has rested. I think a lot of this run up was because the ECB was cutting rates. They cut 200 basis points on rates, but they've paused in their rate cuts, and that just stopped the rally in its tracks on the EWG. The economic data out of Germany is not very good. And so now you're starting to see the trading reacting more to the economic conditions rather than call it the Kool-Aid, which is what rate cuts are. Markets love it when rates are cut. We're drifting below the 50-day moving average. Came back up to test it. We did get a follow-through day here, so I think we have to watch for things moving lower here on the EWG. So there was the break of the 50-day moving average. There was the confirmation day. Now we're back testing the 50-day moving average. The 10-day moving average is right there. We've had this bearish 1030 cross. So perhaps this move up is simply that. It's just testing the break of the 50-day moving average and then perhaps a move lower down into this area around the 38.2% retracement level, which would coincide with the wave 3 high on the way up. We did move past 100% on the wave 5 extension, so we're not looking for a correction all the way back down to the previous 4. We're looking for a corrective move at least to the 38.2% level and possibly down to 61.8. But again, markets trading more on the economic data than Fed or ECB rate cuts anymore. Taking a look at the Nifty over in India, and administration's not very happy with how the negotiations have gone there. More threats on higher tariffs on India, and that's created this wave 4 here. We're at a spot where we could hold. We're trying to. You can see for the last week, we've traded right here where the wave 4 is labeled, which is a 50% correction. There's really nothing else here to hold it. There's no major support level other than a classic 50% correction of the move up coming off the March lows. But that's a pretty solid level that could hold. Once again, if you're looking for the market here and maybe a deal being reached could be a catalyst for a potential wave 5 bounce to begin. We got to get back above the 10-day moving average and the 50-day moving average here as well. And then the talks with China were moved out a bit, a little bit more time. And I think the president mentioned this morning that he would be willing to even extend that as long as he felt negotiations were going well. We did have an alert for our alert subscribers at Evo Trader on the FXI. Here was the commentary on when we close it out, and we pretty much nailed that top as far as the move. And you might have thought, gosh, you're breaking that resistance line. It could have taken off, but we had a pretty vertical move up and a little too much separation from the 10-day moving average. Time matters when you're trading options. So we went ahead and took it off, and we kind of happened to hit the high there on that move. Came back, tested the 50-day moving average. We've labeled the 4, but notice it's green, which means it's still active. So the algorithm is not sure that that wave 4 is complete yet. We're testing the 10-day moving average here, and depending on news of the negotiations, I think is going to be driving where things go in the FXI in the not too distant future. But nonetheless, all the tariff talk isn't drawing any sort of volatility like we had back in April when all the tariffs were announced, and the tariff tantrum, as I called it, that I've been using that phrase, pretty appropriate, that occurred. We don't get that kind of volatility anymore. There can be little short-term moves, but nothing like what we saw there. The markets are used to it. I think they're almost tired of hearing the word tariff, and know that the negotiations will continue. The threats will continue on countries that administration doesn't feel are negotiating in good faith, and we'll see where things play out over the next several months. So that pretty much wraps things up on where we are with the markets as we stand now and what's going on globally. So with that, Zach, we'll go ahead and open it up to some Q&A, and then we can give the folks the case study consideration for this week as we move towards the top of the hour.
Sounds like a plan. Thanks, Rob. Let's get right into it. Got a question here from Trade Simple on TWLO for Twilio.
Twilio, take a look at the chart. We do have AMD's earnings after the close today. We'll see if they can do anything like what Palantir did, which was got to be one of the best earnings reports you've ever heard, or most bullish earnings reports ever last night. Talking about 10x and wanting to have as few employees as possible. In other words, keep the expenses down, utilize AI as much as possible, and just generate profits. Um, anyway, taking a look at Twilio, we're testing the 50-day moving average here. Hit the 10-day moving average on the high. At least we broke out of this tight little trading range that we were in back here through from the beginning of the year. We broke down in April, but pretty much everything did during that tariff era, and then back up and traded through this range for a while. You can probably draw that upper trend line even just a little bit higher up into this area. Might be a little bit more accurate, but nonetheless, we're testing the 50-day moving average, but we got to get back above the 10-day moving average. I don't know when they report earnings or if they did already, but perhaps that could be a catalyst. But the areas to watch are the 50-day moving average, this 120 area. Can we hold that? And then can we get back above the 10-day moving average? So if we can hold here, break it back above the 10-day moving average, perhaps we have some momentum up to that wave 5. A break below the 120 level, and we're probably coming down here to 110. And that could happen rather quickly as we don't have anything in the way. It was a pretty quick move here from 110 to above 120. So if we break down below that level, we're breaking below the 50-day moving average, probably coming down to 110, test that wave 4 on the lower trend line there on Twilio.
Thanks, Rob. Question here from Bruce on the SQQQ.
Take a look here. Ultra short on the Qs, and obviously has not been doing well as the Qs have been marching to the upside. This continues to go down, and boy, the earnings have been so good in the tech sector. We all know the valuations are extreme, but the market's okay with it as long as they're reporting good earnings. For the most part, they're being rewarded with even the really high valuations that they have. A bit reminiscent to me of what occurred back in 1999 into 98 and 99 with the internet when we had a bit of a bubble there where valuations got ridiculously high for companies that weren't even making any money yet. You just came public as an internet-based company and you were rewarded. Seems to be that way with AI now. If you say anything about AI, then you're getting rewarded. You can see Apple has not followed suit because they've really missed the boat on their whole AI plan. But right now, we're trading around the 10-day moving or the 10-day moving average on the SQQs, and it's just going to depend on how long we can continue with these solid earnings reports. These ultra shorts, the 3 times, the 2 times, all these ETFs, the leverage is created through futures. So you get a double whammy on time decay on these. They're almost designed to erode over time more than any other ETFs are. And you have to get the timing right on these. There's no doubt that you can make some money on these if you get the timing right. If you don't, then they go down. Now, if the question is from somebody that's been shorting this, then I think that's a pretty good place to be. Maybe not in the very short term because we might get a little bit of a test lower in the markets if I'm right on the SPY coming down and testing that 610 level. Perhaps the other markets follow. Maybe the Q's not as much, but seems like the whole market needs a little bit of a breather. And perhaps that could put a bid under this and drive it up if the Qs start to go down. But as long as we're trending higher and the tech sector is staying strong and being rewarded, even with its valuations, we're going to continue to move down here on the SQQQ.
Thanks, Rob. Manuel would like to look at a stock you mentioned briefly a bit earlier. That's Palantir, PLTR.
Yeah, that was one heck of an earnings report. Watch that after the close yesterday, and holy cow! I mean, it just you could not sound any more bullish as a company than Palantir did in their earnings report, and we're getting pretty high valuations here on Palantir as well. We're up at 175, but now we have this gap to contend with, this big gap up. I would not suspect that there's going to be a lot of follow through. You can see the wave 5 is now right at 100% extension. We had roughly a 50% correction in the wave 4. We've moved past the 100% extension on this zigzag right here, and look where we hit on the high, the 161.8% extension. So the high of the day hit that exact next fib level. That's what you expect out of zigzags. We had a 61.8% B wave correction. That gives you 100% extension. If you get 100% extension, the next extended level, if that C wave does extend, is the 161.8, and we're there. So now what? Now where do we go from here? I don't know what they could say that would be any more bullish than what they said last night. I think that Palantir is maybe due for a little bit of backing and filling on its own, some sideways movement. So we had the gap up, we had the separation from the 10-day moving average, and a little bit overbought now, short term, especially bumping its head at both that fib level on the zigzag and the 100% level of extension on the wave 5. A lot of resistance right there at 175. Now, if over time we can go sideways here, you don't want, if you're long the stock, you don't want it to go much higher from here because it won't hold. When you break a point of resistance, which is where it would be with 100% wave 5 and 161.8% zigzag C wave extension, probably wouldn't hold and would fall back more. So the best case scenario is some sideways backing and filling through here. Doesn't necessarily have to come down and fill the gap right away, but some sideways movement through here would be helpful. Let the 10-day moving average catch up and see if it can break above 175. If it can, then we're starting to get into the tractor beam effect. You get up to about 180, 185. That to me is where the tractor beam takes effect, and what I'm talking about there. Again, a nod to my dad in Star Trek that was on TV all the time when I was growing up. He was a big Star Trek fan, and other planets would have these tractor beams that would draw the Starship Enterprise towards their planets, and these big round numbers act the same way. It's almost like they get drawn to those big numbers. We're not quite in that area yet, but it wouldn't take much more of a move up. But for now, I would pause and just wait and see how we handle 175 over the next week or so. I would be very surprised if there was much follow through here from that high with the resistance that it's at. I would be more expecting, the choppy sideways stuff from here. And if it can manage to break above 175, get up into 180 or so, then you probably are looking at 200, but it's got some work to do in the meantime. It's going to do what it's going to do, but what's going to drive it higher from here? I don't know, with the valuation that it has, and how solid the earnings report was and how bullish the earnings report was. It's going to have a tough quarter over quarter comparison when it comes to its next quarter earnings reports. But keep an eye on 175. I wouldn't want to go further along here unless it went above 175.
Another stock you mentioned around earnings was AMD. Barbara asked where it will go from here.
Well, that's a good question. It depends on what their earnings say. I haven't done a lot of research to see what's expected. AMD's had a very nice run. Also off the April lows, we had a small triangle here and it took off and just been trading right along. It looks almost like the EWC chart does, just trending nicely in this 45-degree angle along the 10-day moving average. It all made sense because AMD had not followed through with the same moves that some of the other chip manufacturers had. Um, in the tariff talk, President Trump said he's going to announce in the next week or so tariffs on other chips. He wants the chips made here in the US, and that could be beneficial for a company like AMD at 175, very similar to Palantir. We're getting awful close to that tractor beam effect. So far, we're holding there nicely. The earnings report, if it is bullish and we break higher, I think AMD probably does go to 200. But we'll have to wait and see how the earnings report is taken by the markets. And that's a toss of a coin, isn't it? I mean, you oftentimes have seen solid earnings reports and the stock sold off, and then good earnings reports and the stock is bought. If you have an earnings report like Palantir, then almost no choice for it to go up. But I don't know that AMD is going to be able to match anything near the bullishness of the Palantir report. So we could perhaps start a little bit of a corrective move here. But you just have to watch 175 and see how it reacts. So that's my viewpoint. If it's a good earnings report and it's well received, moves higher from here, I think we're on a march to 200. If it's sold off, we're probably coming down here back towards 150 and that 50-day moving average.
Let's head over to SOXX, so the ETF for the semiconductor.
Yeah, and AMD is, yeah, even though it's not in a triangle, you could almost make a case for a triangle there. The problem is when you look at the ADX, you can see it's way too high. It's bullish. I like it when the ADX is low. What that means is that maybe we just chop sideways here for a while. I don't think that's going to happen, though. I think the market will react one way or the other on AMD. Basically 25 points higher, 25 points lower, which is what makes something like a single interesting. So taking a look at the SOX, and maybe we can keep a bid there with the comments from the president and whatever tariffs are going to be announced on chips and semiconductors. So both of them are going to face tariffs. He wants everything manufactured here in the U.S. And we got to get back above 250 though. Right now we're testing the 50-day moving average. We hit it on the low on Friday. We've bounced up. We hit the 10-day moving average on the high today. So right now we've got a little bit of a resistance level here at 250, and I wouldn't be long the SOX unless we break above that level. Now we could just churn here a little bit more around this 50-day moving average. So for me to be bullish on the SOX, it's got to break above 250.
Question for Will. Lulu is a downside play. The chart looks terrible.
Yeah, you know, they had their day, didn't they? When COVID came and everybody's working at home, and they had just announced their men's line, and athleisure became the big thing, and they timed all that right. And since then, a couple things have happened. One, the economy has slowed a bit, and people don't want to spend $120 for a pair of leisure pants or yoga pants for the ladies, and a lot of other companies have caught up with more quality in their own athleisure wear and yoga clothes. So they're facing a double whammy there, and then they've got increased costs, and they have a hard time passing those on. That is a pretty ugly chart, Will, I agree. The only thing that you could look at from a bullish standpoint here, I think, is that we are right smack in the middle of the tap box with this wave five. Short term, very short term, we're still a little bit oversold. You can see we kind of ticked down here towards the end of last week. and got a little separation from the 10-day moving average. So that's what happens. We're going sideways here, allowing the 10-day moving average to catch up. And if we continue lower, I think we probably move down towards the bottom of this tap box. And I don't know where the catalyst could be for anything too bullish on Lulu. Again, with the cost of their clothing and the economy weakening a bit, consumer not spending like it once was, all those things hurting Lulu significantly. So I don't know where the catalyst is for that to move higher, and I would not have really any interest in this going higher unless it could get back above the 10-day moving average, and then maybe an aggressive play could be back up here towards the 50-day moving average and a little bit of congestion that you have right through that area right there. You can see we had congestion there in June and July. It also was the April low. And it managed to run after the April low, but everything did. And then bad earnings report and broke lower. They've got some work to do there from a technical standpoint to generate anything positive. I'd keep an eye on what happens when the price of the stock and the 10-day moving average meet again and see if there's any further drift down. We had a 57% wave 4 correction, so this wave 5 could easily extend down to 100% down to the bottom of this tap box. Wouldn't surprise me at all to see that. But right now, it's just consolidating the previous or the move at the end of last week as we broke below the 10-day moving average and letting it catch up. And perhaps there's more drift. But for now, it leans lower, I think, unless we somehow break above that 10-day moving average.
Thanks, Rob. Lisa would like to look at VG.
There has been, some interest in some stocks along this line. This one is really interesting because it is a pretty nice descending triangle pattern. Take a look at where the ADX is here. I don't know what the options are like, if it's liquid enough, but just from a basic pattern structure, it looks great for a triangle because it's got a really nice descending triangle set up here. Well-formed triangle, and you can see all the touches of the line on the lower highs and the support level. That's going to break out. I can't tell you which direction, no idea which way it's going to go, but it's going to move 2.5 to 3 points from here, which would be enough on a triangle. But once again, I don't know what the liquidity looks like on the option side of things and whether or not that would be possibility. We can take a quick look here. Yeah, there is some open interest. It's not super high. Spreads are too wide, though, at least on the put side. Not as bad on the call side, but still a little too wide. The rule that I like to look at is 10%. In other words, if you pick the mid price between the bid and the ask, you don't want the spread to be more than 10% of whatever that price is. So this is a 20-cent wide spread, and if you're at 65 cents, you would want that spread to be more like 6.5 cents, not 20 cents. So those would be considered expensive options from that general rule on the width of the spreads. So from that standpoint, even though there is a little bit of open interest, some volume today too, I don't know if that would work. That's a weekly. Let's get to the monthly and see maybe if it looks a little bit better. A lot more liquidity here, but the spreads are still a touch wide, not nearly as bad though. But some activity here as well. Let's get the deltas on here, see what that looks like. And you got to come down. Enough open interest here. Still a little bit wide on the spreads, but not too bad. You could actually look at, I think, a strangle here. That's August, so that would be too soon. But if you were to come out to maybe November, still lots of open interest here, plenty of open interest in the options, and still a little bit too wide on the spreads. And the problem with that is if you split the spread, you could probably get in, but then the difficulty would be getting out. With that much liquidity, though, it might not be as much of an issue. There's just a risk by the time when you're doing a strangle and buying the call and the put, so you've got the slippage on the spread on both sides, the call and the put, and that could take away what would normally be a decent gain in the trade. So the width of the spreads makes that one a problem, but everything else looks good as far as a breakout move coming here on VG. And once again, don't know whether it's going to be the upside or the downside, but some sort of a move is going to occur there. Maybe with the width of the spreads, instead of doing a strangle, is just let it make its directional breakout and then trade the direction that it breaks out. And then you only have the slippage on one side, whether it's a call on an upside breakout or a put on a downside breakout. But interesting chart. I haven't looked at that one.
Interesting chart indeed. And I see we're a few minutes after time. So if you want to head back over to the case study consideration for this week, and per usual, we have lots of outstanding questions, but with the hour that you've generously allotted, I know we need to get to the case study consideration and get back to the markets. So I'll pass back over to you for that.
All right. And since we don't have anything that's actually following all the rules of one of the portfolios in the Evo Trader portfolios or the AI, I am going to just do this one as a post, not an idea that I would expect, because that's what it is. It's just a thought. It's not an idea based on all the rules. And when we post an idea, it's because it follows all the rules of one of our portfolios. And then it's an actual idea. Sorry, I'm taking your speech away from me there, Zach. But when we just put a post, it's just, I think that this is something that may happen. I feel like the SPY may come down and test that 50-day moving average. So that's going to be it. We expect the SPY. I don't think it would be a bad thing, just as general portfolio maintenance with where we are right now, to have some SPY puts against whatever long positions that you may have anyway. So that's it. I think the SPY is likely to test the 610 level that coincides with the 50-day moving average.
Alrighty, very well. Well, I think you covered the post in good detail there. So everyone be sure to look out on the Hub platform for that post that will be available shortly after this live session is complete. And Rob, I'll pass back over to you to add concluding thoughts.
All right. Thanks, everybody, as always, for spending some of your time with us this afternoon. Again, we talk about this each and every week. Very much appreciate and value your time. Time's the most valuable asset that we all have. And we appreciate you spending some of yours with us, especially during the trading day. That's what makes this fun. As always, you guys ask great questions, good symbols. I love doing this session every week because you come up with symbols that we don't normally look at and aren't the ones that you hear about day in and day out on the network. So interesting session as always. And let's see where the market closes today. That's going to tell us a lot. So have a great